Guys, Mateo's here. How you guys going? Okay, that's good. Okay, hey guys, how's it going? It's Mateo's here. Today I felt like doing a bit of a different video to talk about how startups have been evaluated over the last decade, over the last 20 years or so. I wanted to make this video mostly because if you guys are into business deals or you into the startup world or entrepreneurship and all that, you probably know about what happened to WeWork in these last few months ever since they filed for IPO in August, I believe. I just want to talk a little bit about that because what happened was everyone has always had a very good image of WeWork. And then ever since they filed for IPO, and the investors, people who were thinking about buying the shares when the company went to an initial public offering, everyone kind of got discouraged. And it's mostly because of the numbers that the company has been showing, which are very, very weak numbers. And the valuation was massive when they first filed for IPO. They were valued in $47 billion. And actually, if you guys don't know about the WeWork story and everything that happened, I'm going to leave a few links to news down here in the description, so feel free to inform yourself about it. It is actually something that I've never heard in the startup world and probably anywhere else in the business world in general, and probably you've never done it as well. So what it seems to me right now is that an entrepreneur's aim when he or she creates a business is to get funded. Because what's been happening in the last 20 years or so is that startups that receive funding from investors, they usually succeed. But the only ones who succeed is the one that we know about, because there's a lot of startups that also don't succeed that we don't know about. But most of them, even though they got funded, they still fail. That is exactly what has been worrying me a lot, is because an entrepreneur, when they found a company, when they create a product, ultimate goal now for an entrepreneur is to have funding. Please do not get me wrong. I know that nothing in the world of startups will probably help as much as investors coming on board and injecting money into that startup. And not only the company is going to have money to invest and to grow, but those investors are also going to hire people to adjust the company's corporate and legal structure, and that is going to be invaluable for a company to succeed. And that's exactly why getting funded is just so important for a company these days, because when it comes to this global market, when this global competition is very important for a company, even more a tech company, which most of the startups that have been succeeding in the last few decades are tech startups. It's very important for them to have this explosive growth, and you're only going to have this explosive growth if you get funded, if you get very fast money and people who understand the business. I read a few news about this subject. I read a few news about startup valuation and how funds and investors, they evaluate companies, because I know a little bit, but when it comes to the actual matter, I don't really know all the steps that you evaluate a company. The only people who do know are people who actually do this for a living. I'm gonna read a part of the news that I just got from Forbes talking about the WeWork IPO so that you can understand how overvalued the $47 billion that WeWork had on its IPO was. WeWork might not be the largest IPO of 2019, but it is easily the most ridiculous and the most dangerous. At least Uber and other recent big money IPOs offered some legitimate innovation in their business models, even if their valuations were too high. WeWork has copied an old business model, which is office leasing, slapped some tech lingo on it, and it sucked venture capital investors into valuing the firm at more than 10 times its nearest competitor. The company also burns tons of cash, carries huge risk factors in a recession, and sports some of the worst corporate governance practices I've ever seen. WeWork, which is We Company these days, is in the danger zone. This article was written by David China. So if we talk about valuation, valuation is nothing more than the future number that the company is going to be worth and how much sales this company is going to be generating. But we have to try to translate that into present numbers. And the problem is, because of so many companies are still trying to test their value hypothesis, there's so many assumptions that we have to make. And that changes a lot of how much a company is going to be valuated. So if you take two exact companies, one of them is generating sales and the other one is not. The one who's generating sales obviously is going to have a higher valuation because the company has already cash flow. They are already generating sales. So it's not that big of a risk for the investors. So if we get a second example, and two companies have the exact same number of sales, but one of these companies has already proved that they have a sustainable product throughout the years in the market, and another one is still trying to prove their value hypothesis, if the product's going to be sustainable throughout the years and all that. The first company is going to have a higher valuation because it's not that big of a risk for the investor to inject money on that company. And I think the problem with that is, the problem with investors these days is that in the last few years, probably ever since they invested money on Facebook and it just grew so much, a company getting funded means so much, not only for investors and for the company itself, but also for the market. And that's probably what has been causing a very inflated valuation on the tech startups in the last decade. And with that, when they file for IPO, all these tech startups, they also disappoint, because when they have to show the investors their actual numbers, investors, when the company goes to market, they want sales, they want profit. They also want exposure, but investors, the market ones, they're not really willing to take that much risk on a company that's still not making profit. And that is definitely why companies like WeWork, Uber, and Airbnb have been disappointing so much when they have to open their numbers for initial public offerings. They're not profitable companies, even though they're tech unicorns and they have billions of dollars in valuation. They're still not profitable companies. They have nothing to offer to the investors. They do have a great business model, they do have revenue, but they're still suffering losses. So how in the long run are they going to overcome these losses, make a profit, and deliver for the investors? And this is the exact type of risk that people in the market don't want to take. And betting in companies like this became even bigger because Amazon sustained losses for so many years in a row, and they managed to keep investors positioned. And then one day they did manage to make a profit. Amazon now is a profitable company, but they took more than 15 years to start making profit. Of course, they didn't have big losses like WeWork had, like Uber had, and that is probably the biggest difference between Amazon and these other companies. Amazon, while the retail part was making profit, AWS was able to sustain almost the whole business and able to keep investors calm. They had a plan. Jeff Bezos and the corporate governance team, they had a plan. They told the investors, this is the plan, it's gonna start acting X years from now, and it actually did. If you think about it, what is WeWork's plan? We don't know what WeWork's plan is. The business model is not gonna change that much in the future. How are they gonna make profit? And the biggest difference between Amazon and WeWork, for example, Amazon grew, they managed to keep growing, but they also managed to, each year, they would lose less money than the year before, and they would make more money than the year before. Therefore, at one point, they did become profitable, and now they're each time more profitable, each time with a bigger revenue. And that's the big difference. WeWork, each year, they lose more money than they lost in the year before. So that is the big difference. Amazon was actually showing signs of growth and showing signs of sustainability and at one point profitability. I think the point that I want to make in this video is not only that there's something wrong with the current valuation methods that investors have been using with companies, and I think now with this SoftBank thing, with all the money that they put in, investors are probably gonna try to change that. They're probably gonna try to change this valuation method that has been happening over the last decade and try to probably make less assumptions and less risky assumptions, and they actually try to look at the core business and the values that the startup is offering to the market, and they're gonna base a lot of the valuation on that. The point that I also wanna make is that if you have a company, if you own a startup, and if you didn't get funded, it's no loss. Not getting funded isn't a loss, and getting funded isn't a win, because getting funded is not the end of the game. If I have a company and I go pitch some investors, probably if you pitch 5 and no one takes your idea, if you pitch 10, then probably something wrong with your idea, so you probably have to reevaluate and actually go there. You probably have to change a few things, but it doesn't mean that you have a bad idea. And the same thing is, it doesn't mean that if you got funded, you have a good idea. That's exactly the example of co-working space. Co-working space is not a new technology. There's nothing technological about co-working space. There's nothing that can be trademarked about co-working space. So why is WeWork that big? If we think about WeWork in IWG, which is the second biggest company in the co-working space, WeWork was valued 10 times more than IWG, When IWG had more square meters worldwide, they had more people working for them, they had already a bigger revenue than WeWork, and they were already a profitable company. So that's 4 things of why IWG and WeWork are different. And we still go with WeWork, probably because they got funded. And that's usually what happens. So let's please think this way. Don't think that just because you didn't get funded, you lost, and because you got funded, you won. That's not how it works. And once you do get their money, please spend it the right way. Know how to spend your money. So I'm just gonna wrap it up. You got funded, use your money wisely. Know how to spend your money. If you don't know how to spend your money, hire people that know how to. I think that's gonna be all for today. That's my wrap up. I'm not even gonna tell you guys to subscribe because I know you're already subscribed. You know you've already liked this video. Have a good night, keep grinding, and that's it. Have a great day.